Hi, we're back with an early global view on Tuesday, October 6, 2015. It's currently 7:45 a.m. We're coming to you a bit later than usual because we wanted to see the U.S. and Canadian trade balance figures, both of which were weak, in fact. And also, we want to review a bit of how the weak data has come back overall, in spite of the rather impressive performance of the equities since Friday. And we have to ask, where does that leave us in the markets? Well, it leaves us right now off about $3 on the S&P 500, down at 1972. And that's interesting because, of course, 1970 is one of those key old gap areas, going back to the lead contract gap lower back on August 24th, which has acted as a pretty fair arbiter of the market activity. You see, you have stuff around 68 to 70, and you can even see how that affected the market going back to yesterday morning when the market stalled at 68 originally, and it'd probably have to get back below there to look weak again. That said, it does have support back down into the 50 to 45 area. This has been an important lower end of that gap from back in late August, the opening gap on the daily chart for the week on August 24th. And it's also now another important daily chart indication we'll look at when we get to the intermediate term charts. But for right now, what we know is that if this market can find a way to stay out above 70, next resistance is up at right around 1990. 2000 doesn't really mean too much. The next big resistance is up at the 2010 to 2015 area. Significant Fibonacci retracement here and the lead contract breakdown on the weekly chart. If it does crack 50 once again, we would be looking for it to head back down at least two, if not below, the 1930 and even more so 1920 area. Key congestion, especially that 20 is a more major historic area, but with the bigger support back down in the 1900 to 1895 area, it tried to fail below on Thursday, again on Friday, and couldn't stay down. And that pretty much does it for the short-term view of the S&P 500.